You may hear the terms private credit student loans, or private loans. They all mean about the same things. Loans for college that are not made by the United States Department of Education. These are about 10% of all loans made for college in any given year. They tend, though, to be lumped into the general category of student loans. That's a little misleading because most times the student's actually not the primary borrower. The parent often is. We'll talk a little bit about that in a minute. But let's just start with the basics. Who is the lender? As I said, it's any entity other than the U.S. Department of Education. It could be a bank, credit union, finance company, a state agency, or a state-based not-for-profit agency, maybe even the college or the university. Well, how do you find these lenders? The lender may actually be someone you're already doing business with. Might be your bank or your credit union, maybe your credit card company, one of the state agencies. Or you can Google, like always. You'll see the list of lenders, or you may find one of the private loan marketplaces that have evolved. Well, how do you apply for one of these loans? Each lender has its own application. Private lenders utilize their own credit underwriting process very much in line with how they decide whether to make a mortgage loan, an auto loan, a personal loan, or any other consumer loan. The credit decision process is about the same. The fundamental difference is when they're lending for college, there's no collateral, there's no car, there's no house, there's no other asset used to secure that loan. They can't repossess or take ownership of the education, so they rely on a borrower's general credit rather than the value of the asset to be financed. Although each lender will have its own unique set of underwriting requirements and standards, there are some commonalities, some common underwriting criteria, usually including being a U.S. citizen, having some minimal FICO score or other credit score. When I say minimal, usually in the 650 to 700 or maybe a little bit greater than 700 range. You'll have to show proof of a stable income so that the lender knows that you'll be able to handle that monthly payment once the loan enters the repayment stage. A debt to income ratio is usually also calculated, and they like to see that generally in the range of 40 to 43, maybe 45%. And also the school, that is your son or daughter's college, will have to certify that the amount that you want to borrow is not greater than the total cost of their attendance, less whatever financial aid the student may have received. Now, many lenders will allow you to pre-apply for a loan with what's known as a soft pull credit report. That means that you can shop around without having a negative effect or a reduction in your actual FICO or other credit score. If it were a hard pull, when they're actually going to make a final decision, they'll do a hard pull, that could lower your credit score minimally. Now, not many college students are eligible to meet private credit lenders' credit tests. The students need someone else who can pass that credit test, someone who's been established, someone that the bank says is a credit-worthy entity. Now, the credit-worthy borrower gets the loan, and then the student can co-sign it. This means that the student and the parents are equally obligated to make the payment on that loan. If one of them misses a payment, the lender then turns to the other, will contact the co-signer to make that payment. As I mentioned earlier, many times these loans are called student loans, even though the parents or another credit-worthy obligor is the first primary borrower. It's still known as a student loan. There's one other important point that I think is really important to get across. And that is, once the student is established, private lenders will often permit the parents or the creditworthy cosigner to be released from the loan. Now, there's a lot of devil in this cosigner release, but it's a great way for parents to get a loan to help their child when they need it, that is, when they're getting into school, and then being released from the obligation to pay the loan once that recent graduate gets a job and has established themselves as a good credit risk from the lender's perspective. What are some of the common cosigner release requirements that lenders have? Now, everyone is different, but generally, the student needs to be of the age of majority in their state. They have to have graduated or received a certificate of completion from the program. They have to have a minimal level of income determined by the lender, again, to make sure that they can handle that monthly payment. they'll need to have made some number of on-time payments of interest and principal. It's usually 12 or 24 months of on-time payments. Then the lender will take a look. And of course, they have to demonstrate that they're good credit borrowers, meaning they have an acceptable credit history, including no bankruptcy, no foreclosures, no student loans in default or 90 days delinquent in the past 24 months. So now we know about the lender, the credit criteria, the creditworthy co-borrower, and the co-signer release. Now let's talk about how much the loan is going to cost you. Private credit loans generally do not have an origination fee, so it really comes down to the interest rate. And there are two things that you need to understand when it comes to interest rates. First is what type of interest rate is it, variable or fixed? And then what interest rate will you be charged? Let's start with the type of interest rate. Variable rate loans, as the name implies, are variable. They change periodically. If you're considering a variable rate loan, here are the four most important questions to ask. First, how often can the interest rate reset? Now, for some loans, that could be as frequently as monthly. The second question, is there a cap on how much the interest rate can increase or decrease each time it resets? Third, what is the highest rate you might be able to be charged? What's the greatest rate the lender can charge you? It's based on the state you live in, usually a usury charge. Some of these rates, though, it's not uncommon to have some of these rates at 15% or higher. So you need to check that. And then fourth and finally, does your monthly payment adjust when the interest rate changes? Okay, once you understand the answers to these four questions, you'll be able to move on knowing how this will affect your budget. And that's really pretty critical. Now let's look at fixed rate loans. That's much easier. Fixed rate loans are easy to budget because the interest rate that you sign up for will be charged the same amount over the life of the loan. This means the monthly payments won't change either. Once you know the rate upon origination, it will not change for the entire course of the life of that loan. Again, making it very easy to budget. Now, you can always pay more than the required amount. This is known as a prepayment on a loan. There are no penalties for prepaying private loans. And if you send more than the required amount, it will reduce the amount you owe dollar for dollar. This is a great way to reduce the total borrowing cost in your loan over a long period of time. There are three final points that I'd like to make before we go to a recap. And that is, first, loans will begin to accrue interest as soon as they're made. Now, some lenders will permit borrowers to defer interest or even interest and principal payments while the student is in school. If you don't pay at least the interest while the student is in school, the amount you will owe when they graduate will be more than the amount you initially borrowed. That means you will pay interest on that greater amount over the life of the loan, and that will drive up, sometimes pretty considerably, the total amount of interest that you're paying on that loan. Private credit loans are non-dischargeable in bankruptcy. That means that unlike credit cards and other debts that can be reduced or even wiped out entirely if you declare personal bankruptcy, it's nearly impossible to have private credit loans discharged in a bankruptcy. Only in very rare cases of extreme financial hardship do judges allow private credit loans to be dismissed or reduced. And then finally, I just want you to understand that each lender has a student loan servicer who will be responsible for collecting your payments. It's really critical to know who is servicing your loan and to provide them with current contact information so they know where to find you for payments and also for additional collections. To recap, here's what you need to know about private loans. First, the lender is not the U.S. Department of Education. Second, the borrower needs to pass the lender's credit tests. Most students cannot pass that credit test on their own, so they seek the help of a parent or other creditworthy co-borrower, and then the student becomes a co-maker or co-signer on that loan, equally obligated to make the payments. The interest rates can be fixed or variable. The rate you get will be based on your credit profile, and most lenders offer a co-signer release. As with any loan, the devil is in the detail, so know before you owe.